Mahesh Narayanan. I'm the Program Director for Series A, and welcome to Newchip's online demo week. You're about to watch a fireside chat between myself and one of our mentors, Sunny Patel, and we'll be talking about Spaks. Connect with me on LinkedIn and Twitter. And if you're a Series A company looking to raise money, let's talk. Thank you so much for tuning in to Newchip's online demo week, and let's get started. All right, Sunny, let's go ahead and get started. What I'll do is I'll just give a quick intro to you or about you, and then just jump straight into the slides.
Yeah, of course. So I know you wanted to keep this discussion based. So again, for the group here, our team has prepared a few slides as more so as supporting materials. Certainly not something that we're planning on, going through every single line by line, but at least if it helps give some visual resources in this conversation, we figured that'd be useful. So just to give a brief overview on our company, I'm the partner at Amber Consulting. What we really focus on is helping really seed to Series B, C startups with a lot of these kind of business strategy functions, including pitch decks, valuations, financial modeling. We also support a variety of middle market funds, in particular VC, crypto, and private equity funds when it comes to capital deployment. And then also a select group of Fortune 1000 companies. So you can see some of the logos we have here. And we facilitated $2.7 billion in M&A and $600 million-ish in PE and VC fundraising. So yeah.
All right, and Sunny, I just want to give a quick intro about you as well. So you're this obviously the managing partner for Amber Consulting, and you're a CFO at Accounting, and also a strategic advisor at Newchip. So again, thank you for being part of Newchip, and also wanted to thank everyone else for joining us for this fireside chat with Sunny. You also hold a FINRA Series 62, 63, and 700 certifications. And you're able to obviously help companies all the way from Series A up to Series C or even higher. And I know you worked in quite a few Fortune 5000 companies as well, as I mentioned here. So again, it's a pleasure having you here. It's a pleasure to kind of talk about some interesting topics that are coming about, primarily around going public, and one of those ways being SPACs. So let's jump right into, what are the different ways to go public? What can companies consider as they go into the public markets?
Yeah, sure. So, I know this has three, but there's really two main ways companies can go public, and that's IPO, initial public offering, or a direct listing. And then, Mahesh, are we going to distribute this to the people?
So yeah, everyone should be getting a copy after this. Yeah.
Okay, great. So I don't have to go into too much detail, but yeah, effectively, there's two routes, right? If you go the IPO route, that includes hiring underwriters. It could be a long process dependent on the type of business you are, the industry you're in, and really the amount of capital you're looking to raise. There are a lot of contingencies when it comes to IPOs, and the reason is because you are getting money from retail investors, and the SEC is very focused on protecting these investors. So, that's kind of why the IPO process can vary in time, cost, and outcomes, really, right? Like you can file for an IPO and get denied, and that's what WeWork did, and then they ended up going public through a SPAC, right? So we'll talk about that. Direct listings is where you just take your existing stocks and you trade them onto the market. It's usually half the cost of an IPO. The difference is there's less price certainty, right? Because in an IPO process, you hire an underwriter, which is typically an investment bank, and they'll go around and have a roadshow where they go to a bunch of institutional investors that can prop up your IPO price. Whereas if you do a direct listing, there's less of that. So there's pros and cons to each route. And then SPAC, which we're going to dive into today, this is special purpose acquisition company. And effectively what that is, it's a fund that's already IPO'd, and this is traditionally called a blank check company. And then once they IPO, and we'll get into all this, they have about 2 years to buy a target, which is typically an operating company. once they buy that target takes place of the public traded vehicle, and then that becomes a publicly traded company through the SPAC.
Right. So in essence, like IPO is basically like a company looking for money, right, in the public market, and then like a SPAC is like money looking for a company, right? You pretty much have all of the money ready to go, so let's jump into a SPAC. Let's kind of look at the structure of what a SPAC looks like, and then we'll jump into the details around who should consider it and so forth.
Yeah, sure. So yeah, and I might flip back and forth through these slides because this discussion's pretty free flowing. But
sure.
Effectively, the structure of a SPAC. So you have a bunch of investors, and then sponsors raise money into a SPAC. So, all that money gets funneled in by traditionally sponsors. Sponsors take 20% cuts of the equity pool. And then once that money goes into a SPAC, right, the structure of it is basically 100%. And really, there's a few different ways of buying companies. Typically, they'll just buy all the equity of a private company, and then that company gets listed publicly. So this is kind of like the flow chart of things from a very high level. And to answer your second question, in terms of who should consider a SPAC, really the way to think about SPACs, and we can get back to this, is it's very situationally dependent, right? So if you're a public company, or if you want to be a public company through an IPO, there's certainly pros and cons to that. There's pros and cons to a SPAC, right? And that's all stuff we can talk about probably towards the end, Mahesh, if you think that makes sense.
Yeah, absolutely. I guess part of that is I guess kind of going through the overall discussion. SPACs have really bumped up in interest probably starting in 2019, looking at 2020. That was supposed to be the year of the SPACs, but then just in 2021, the first quarter of 2021, there have been more SPACs and more money raised than all of 2020. Right, it's like $88 billion, 290 SPACs or so. Why is there this new interest in SPACs versus going traditional IPO? What's causing this jump in SPACs?
Yeah, so it's funny. SPACs have been around for a long time, but I think as the media starts, getting wind of billions and billions of dollars being kind of transferred this way, people start getting interest. But this was something that traditionally Wall Street did not like. It was something the SEC did not like. The reason why it works now, there's some conceptual reasons, of course, like we're seeing massive capital inflow. PE funds have a bunch of dry powder. You can argue that that's a result of a lot of inflation and low interest rates, record high valuations across the board of tech companies. SPACs, generally speaking, are a lower transaction fees. So, an IPO, it's like 3 to let's say 8%. SPACs are very low because you're basically just getting acquired by a public company. We have some supporting charts here that I actually think help tell that story a little bit. So, massive amount of money, not a lot of places to put it, right? And then the valuation of companies are at records highs. So, because of all these factors, there's really two big things. One is uncertainty. So when the market is very uncertain, it's hard to pay an underwriter 8% to do an IPO if you don't know what that IPO price is going to be. What a SPACs offer is greater price certainty because it's all privately negotiated deals. So you will effectively, it's a closed door process. Valuation happens behind the scenes. In a SPAC, you're actually able to disclose projections. In a traditional IPO, you're not able to disclose projections. So because of the market, right, in combination to a lot of capital, high valuations, investors as well as private companies have turned to SPACs because they find this as an alternative route to get listed publicly without going through all of the hurdles and regulatory junctions of like the SEC, right? But the biggest thing is really when it comes to a SPAC, you're basically blindly giving your money to a sponsor who is then deciding whether or not they source companies to invest in. And because of that, you need to have very, very strong, credible people in the market. So, we're seeing like really, really strong financial background people run the SPACs. And because of that, this is gaining traction. But traditionally, this was actually like not an attractive asset or kind of an investment opportunity for most investors. But that's changing because of all these macro and micro conditions.
And do you think, because as you're saying, more and more companies, or at least, as you say, more and more well-known individuals are, coming on as sponsors and are able to kind of, get the credentials that you need to then go forward with a SPAC. Does that, in essence, accelerate the process of going public for these companies, right? Because there's less financial statements, there are less related materials about these companies, and so it's pretty much like a company that's already public, and then you're kind of bringing in a private company in. So does that really accelerate it, or does that increase the risk for companies?
So you mean in terms of like a private company?
Yeah, for a private company, right? Like, is that a good thing or a bad thing to go a SPAC versus an IPO?
Yeah, exactly. So I would say this. At the end of the day, it's very, very situational specific. Now, in terms of the broad industry, look, just to be, I'm a former banker, right? So this is kind of like Sunny Patel, the Wall Street banker, tells all. But most IPOs are a bust. What happens is retail investors get the short end of the stick. Institutions and banks take fees throughout the entire process and hand the ticking time all over to investors. Now, of course, a lot of companies, this isn't the case, right? Like, and that capital is for sure needed to grow. So I would just say, like, majority of IPOs, and I've run this process, so I get how it works, right? Like, there's a whole process of IPOing, including information, publishing news articles, building hype, building the book. And then again, like, the institutional guys who invested early get a 20% discount before it goes to the public. And then they start slowly selling their shares to retail investors over time. So generally speaking, IPOs versus a SPAC in terms of the market, it's just, they're similar in the nature of what they do is to transfer capital. The difference is, from a private company's perspective, is, again, timing. So let me see if I have a slide here. And if not, I can just talk about it. So, okay, so some of the differences really are timing, right? Like, to go from your perspective as a private company, if you need to go through a traditional IPO process, first you need to prepare everything, and then you actually execute on that. As if you're going public through a SPAC, once that fund's already raised, and then you can go public in 3 to 5 months, which is unheard of in most IPO processes. So one is timing, right? The other the other pro is price certainty. You know exactly what your valuation is, what the dollar per share once you go public is, because it's a privately negotiated transaction. Whereas if you go through the public routes, your stock prices move up and down consistently before the listing. Anyways, and then some of the next things are fees. SPACs are cheaper. There's less filing up front, but once you're public, the filing is very similar. So you still need to actually go through your 10Ks, your 10Qs, and you need to have the same reporting metrics as any public company. You just need less upfront stuff. And the other really pro is additional capital. So if you go through a SPAC, right, and you need to raise more money, you can do so through a PIPE, which is private investment in public equity. And that's money from institutional guys. Whereas once you IPO, you can't really you can issue more shares, but it's at the risk of diluting your current positions, as well as just, it looks bad if you just IPO'd and then you're issuing more shares, right? So in a private transaction like a SPAC, it's much easier to get more and more capital. But there's also cons. So if you're a private company and you go through a SPAC, typically you lose 20% of your equity to a sponsor, which is, again, the guys that set up the fund, that raise the capital. You automatically just give them that capital. The other issue with SPACs is, so once you get to, and I think it's on here, yeah, once you get to whether or not once the process becomes where we've identified the target and you're ready to execute, shareholders or investors can actually opt out. They have warrants as a part of their issuance for the SPACs, and they can say, we just want our money back and we don't want to invest in this company. Now, what happens when 60% of your investors do that? Well, now you could have just gotten $100 or $200 million of capital pulled out from underneath you, right? So there's kind of there's an issue with that. And then I think the last con really is just, generally speaking, big companies like some of these guys do well with SPACs, right? But there's others that it just causes a lot of concern. And I think if you look at the WeWork example, where they filed for an IPO, didn't get it, and then they went through a SPAC, I mean, as an investor, what kind of signal does that give you, right? So it's like, whatever route you choose, I would just be very careful, think about it fully, and understand the ramifications of both sides.
And Tony, so what are the ramifications for investors that you already have if you've already raised private money? How do they benefit? How did they get hurt? Because it's a common question that many other entrepreneurs want to know is, great, I already have all these investors. What happens to them if I go SPAC?
Yeah, and ultimately what it comes down to is just the economics of things, right? So for example, if you have investors at, let's say your total capital inflow over a series A and B is like 100 million, right? So you get that 100 million, and now you look at your options, right? And of course you can try to do another private series raise, VC guys get in there. You can look for an acquisition by either a competitor or an institution, or a financial person, or you can also get more money from the public. Now, it depends on, I would say, the economics. For example, if you can get the most bang for your buck for, say, going through an IPO, then you're much more likely to have higher returns all across the board. But that, again, there's risk with that route because there's fees. It can take a year or two. Your stock could just not do well. So because of that, it's usually companies with at least 100 million rev. I usually advise companies to be at least 500 to 600 million in enterprise value to be listed on the public markets, because once you do that, it's like you're subject to a lot of scrutiny. You have reporting, and also you have to disclose a lot of things to, let's say, competitors. Companies like Tesla and Nike and Adidas, they do well in the public markets, but that's because they're so large. There's a whole host of smaller guys who think that, we're going to IPO, make a bunch of money. Then they disclose a bunch of information throughout that process, which is all publicly available to their competitors. And that can be a problem. Now, that being said, there's a ton of privately held companies that are extremely successful, right? Extremely successful. So it's kind of like, I think the headlines make it to where people think, I'm going to IPO and this is going to be amazing. But what they don't realize is all these hassles before, during, and after that they have to go through. And sometimes it's just not worth it to current investors as well as the management team in terms of ROI. So it's a hard question to answer without like specifically diving into the company and the market and what the economics are. But ultimately, it comes down to, if you can make more money publicly, it would be better returns for investors.
Right, and I think that's the other caveat to all IPOs or any public market is that it's an exit for your investors, but not necessarily for the team. Right, like the team still has to be there. They're still building value for the company, and they have to just now build value for more shareholders than before. But many of the investors leave either doing an IPO or even doing a SPAC, but the team still is there. So it's not really an exit for the company. Really exists just for investors. So it's just one thing you have to kind of keep that in mind as well.
Yeah, and what I would say is when it comes to liquidity events, I mean, even an acquisition, like most investors in their agreements, right? Like they define liquidity events as an acquisition, maybe as another fundraise, right? Or an IPO. So like, there's multiple ways to get your investors' money back to them. It all depends on, even if you IPO, they might still want to keep your stock. They might still want to keep that. So it's more so the liquidity in terms of transferring certain shares on a public market versus, I own stock of a private company. Now I got to run this process to sell my shares to someone else. And it's not as liquid. So there's just a lot of price volatility. And some clauses actually don't even allow investors to do that necessarily until a certain point the company's stage or growth cycle. So.
Right. Now, in terms of, at least based on your experience, you've taken a couple of companies through SPACs already this year, right? And so, how do you see this trend moving forward? I mean, do you think, the number of SPACs, the number of companies looking at SPACs, is it going to continue? Is that going to kind of stabilize? Is it going to start falling in 2021 moving forward? At least, what are you seeing within the market, and what do you anticipate happening?
Yeah, so I think the best way to answer that question is to actually look at all the different parts that led to this happening, right? So we can just go through those really quick. In terms of dry capital, because of the inflation and interest period that we're in, I just see this continuing to go up and up, right? I mean, it's kind of like when COVID first happened, I thought, oh my God, the economy basically is done. Like, this is terrible. This is unheard of. What did the government do? Print trillions and trillions, give trillions in stimuluses, and the markets have fully recovered, if not even to higher highs, right? So it's kind of, even though that's not a representation of our economy. So the way I think about it is there are certain factors historically that have led to this, which again is dry powder, it's high valuations, and it's also uncertainty. But that being said, depending on what happens in the future, especially with Bitcoin, like retail investors getting into different crowdfunding platforms, and just different money coming from different places, the SEC could easily, increase regulatory kind of barriers to doing SPACs, right? Like this vehicle was created not to really do what we're using it for now. Like it's really a loophole traditionally for kind of shadier deals to get under through Wall Street. Because of '08, right? We saw like a massive boom, which is great, but now we're just seeing like a exceptionally larger boom. So the way I see this really happening is it's two ways. It's if current trends continue, like this is going to be an avenue as long as the market is uncertain. Once the market becomes certain, companies prefer IPOs. They rather pay the 3, 4, or 5% to make sure that they hire Goldman Sachs or Morgan Stanley to run a very, very sophisticated and buttoned up IPO and capital kind of liquidation process, let's say, versus going through a SPAC route. Now, what I would say is in the near term, 2 to 3 years, more and more companies are raising money through SPACs, and more companies are giving money into SPACs. So there's another chart I can send around, but yeah, like we're seeing an unnormal amount, I would say, of capital flowing into SPACs because investors are getting greedy. Once you start seeing uncertainty to a point where people want to protect their dollars, they're not going to do SPACs. Most SPACs get locked up for 2 years because once you give that money to a SPAC, traditionally, like they have 2 years to do it. And I'm talking about at the institutional level, right? Like not if you and I go and buy and sell a share online, but the majority of their funds get locked up for 2 years. So again, it's like this will be around as long as investors are willing to put their money into this. But as soon as there's a few bad players in the SPAC world, it's going to go back to these lower levels, I would say, or if the SEC intervenes.
And that kind of leads to my next question is obviously there's these new rules that SEC just came up with towards the end of last year about direct listing, and you had one of those as options there as well. How do you think that is going to affect SPACs? I mean, do you still think people want to do SPACs, or would direct listings kind of take over that type of market?
Yeah, I would. Out of all these, direct listings are actually less popular, and the reason being is because your company has to be in a very kind of specific spot to just take your shares and list them publicly, like with less marketing, with less kind of road shows and not a new issuance. So it's kind of like direct listings, I think are fine in terms of like, yeah, I think direct listings are fine, but again, it just comes back to the avenues of capital for a company. Like ultimately going through, and it's easy. Like I said, it's easy, especially early stage. I think these are all Series A companies, maybe B. So it's easy in the early stage to want to prep for this stuff. But my kind of overarching advice is if you focus on building a good business, capital will come in a lot of different ways. Like it's this funny quote. It's like you get the most money when you don't need it, right? And that's very true with the public markets, private investors. So as an operator, you know, the advice that I usually give is, look, just focus on building a good business, and then work with guys like, you know, me or other companies who can advise you on these different routes. Because once you have a good business, the world is your oyster, right? It's kind of like when you're in the in-between phases, and it's like, okay, is an IPO really the route? You know, should we do a SPAC? Again, the difference is in a SPAC process, you're basically going out to all the current SPAC funds and you're asking them, hey, take a look at this company. Would you want to acquire them, right? The money's already there. Whereas the IPO process, you're already front running your company's brand, marketing, kind of all that stuff, and you're gathering interest into your company. So it's a little different. Whereas if you're a good company, I would IPO. But if you're like kind of like a WeWork where you tried IPOing or it's difficult to do, then I consider a SPAC, and that's no shots against it because I'm doing some of that right now. So I'm just saying.
Yeah, which again is another indication of the type of industries that are pushing towards SPACs versus, you know, those that are pushing towards IPO. So what are your thoughts there? You know, what type of companies or what industries are better suited for SPACs versus a traditional IPO?
Yeah, that's a really good question, actually. And you know, to be fair, like, okay, if we look at some of these examples here, SpaceX, right? For example, they are a pre-revenue company, and they said, oh, we're a tech company, you know, and we're going to make all this kind of money, maybe 10 years, 5 years down the line, but we need a ton of cash right now to be able to kind of work on the projects we want to work on. There's no way in an IPO process they would have been able to get the capital they required, because they can't build the hype, because they can't disclose really projections. So you look at this company and they disclose their historicals, it's all negative. SEC is going to be like, there's no way I'm approving this as an IPO, right? So for companies like that, or even like WeWork, right? Like I mentioned, I think SPAC routes are fine, but generally speaking, the appetite for investors, I think the next 5 or 10 years, based on what I'm seeing, it's all tech. Like I've talked to so many investors, and tech has a disproportionately high amount of returns when it comes to the risks, right? So because of that, investors are very bullish into tech. And I think COVID is a primary case study of that. You look at the valuations of FANG companies compared to the rest of the S&P, and they've been traditionally holding the market up, right? But what's changed? I mean, it's kind of like, sure, like I think they're making more money, but investors they're starting to understand that the future is not in kind of like oil and gas or maybe like real estate or industrials as much. No offense for those type of startups, but if you're not building a product that's focused in tech one way or another, you're going to lose, like, period. Like, you know, I've working with so many blockchain companies, and it's, you know, there's a lot of words, of course, like AI and like, you know, like blockchain and big data or IoT that startups tend to use. But again, this is kind of the way I think about it is a lot of companies right now. It's basically like when 2000 came around and the internet came around and all these companies are being built around that. Investors are looking for those type of companies who can leverage and withstand the uncertainty of markets, especially when it comes to things like COVID, right? And I'm working with like major health systems, for example, who before never even thought of doing telehealth. And this is like $50 billion health systems. They're just like, listen, our doctors like coming in, and like our patients, we want to see them in person. COVID happened, and for the patients who are 50, 60 miles away in the middle of Illinois, for example, you know, it doesn't make sense for them to drive all the way to the health systems. And because of that, the companies that are able to withstand and kind of do well during these kind of uncertain times, especially when things like COVID come up, investors really, really have an appetite for. So I would say generally, you know, the best way to get public capital or to get a lot of rallying around your company is if you build it to withstand things like this. And that's where I've seen the highest valuations, right? It goes back to the valuations too. You know, I know this is just everything, but tech companies are insanely valued for all these reasons. So I hope that answers the question.
No, it does. I mean, I think just the distribution of the type of companies that are looking at SPAC, like you have like obviously generalists, but then if you look at closer like healthcare, right, or biotech, those industries are doing a lot more SPACs because just as you mentioned, there's not much capital flow, there's not much revenue upfront, right? And so for them to go public when they have no revenue or no product in the market, it's impossible to go IPO. But a SPAC provides that particular opportunity. So I think, as you mentioned, if you need a significant amount of capital up front in order to grow that $1 billion, $2 billion company in the long run, then SPACs can shoot a much better opportunity than a traditional IPO. Right. So I think overall, at least in generic terms, I think that's probably the best way to put that, right?
No, yeah, that's exactly right. And I mean, again, it's like it's hard, it's a bitter pill for an investor to swallow if he or she invests in a company that, for example, let's say another COVID happens, right, or something similar to this, where the business doesn't operate when things are shutting down. It's just a hard pill to swallow. So I've seen so many things. Like I worked on non-tech deals in the COVID area, and they've been heavily discounted because investors are like, well, I don't know if COVID's going to happen or there's something like this could happen again. And what insurance do I have that your restaurant is still going to be around, right? For example. So I would just say we're entering the very modern era, and it's very exciting for a lot of reasons. And if you can position businesses to really hone in on these key things that investors look for, and because ultimately for them, most investors, it's like, I have $100 million. Where do I put this, right? If I leave it in cash, it just gets eaten away by inflation. Okay, maybe I put in real estate. Well, that's kind of at all-time highs in key markets. Like there's bubbles all across. Equity market is a bubble, right? That's why crypto right now, and I'm a huge bull into that. I actually have a Bitcoin to prove it. But that's why a lot of these companies are very exciting to investors. And tech is kind of going to be the next, really, if it isn't already, that's going to be all the focus. And all these other industries, in my mind, are going to be revolved around tech one way or another.
Oh, awesome. I want to be mindful of our time, and I think that's a great point to end our conversation on. So again, thank you everyone for joining this Fireside Chat.
This was fantastic. Thanks for having me, Mahesh. And this is why I endorse the Newchip community so much, right? It's just because I think that you guys do a good job bringing different viewpoints and perspectives and adding a lot of value to the companies a part of your program. Thanks for having me, and I am looking forward to that next session.
Absolutely. Thank you everyone for joining.
Have a good weekend.
Take care, everyone.
Take care. Bye.